And we are live.
It worked.
It worked. It's value after hours. It's the eve of Cam Harvey's prophecy being fulfilled. Billy's gone. Billy's dropped out. He can't take it.
I couldn't take it. It was oh boy.
Yeah, are you aware, JT? Did you have that in your calendar?
No, this is what, the first inversion or something? Is that where it would be in time?
You scared me. I had to leave.
Billy, yeah, that's what I said. Did you have your advent calendar for the countdown for
I had to get out of
Harvey's
here real
inversion?
quick. Yes, I've been eagerly awaiting.
So,
I love this kind of stuff.
Is it like I'm picturing that like Elmo and he's got his arms up and there's fire? Is that what we're getting ready for?
yeah, the prophecy is fulfilled if we stay inverted through tomorrow. Even though Cam Harvey's tried to distance himself from it.
Don't do it, Cam. Lean in.
I still believe. That's what I think too. That's
Simple model.
Tomorrow.
Wow.
I wonder if Cam has ever faded his own model before.
Yes, he has.
How'd that work out?
Well, what year was that?
I don't want to be too critical because
we're not being critical. We're reminding Cam to stick to his religion when it's tough.
I did want to see how he thought about his own model. So I went and dug up he's got some PowerPoint slides on his like academic page. And so I found one from 2008 when he was delivering a presentation. And he said, yeah, we've got an inversion, but likely to be just slower growth, not an actual decline. So that was not a good one to get wrong. I think that was
housing prices are reasonable and at a permanently high plateau.
So that was score one for the simple model and none again for the experts.
It's a rout. So
he said this time again, slightly slower growth, lower growth, probably not a decline. And I don't know either. I'm just saying that the criteria are what they are. And we have, as of tomorrow, we'll have fulfilled the criteria. That's a quarter below.
Quarter inverted.
10-3 inversion. Yeah.
I don't know what it means, but it's provocative.
Well, supposedly on average 10 months, which I guess that's a very specific pinpoint answer, but there's probably a range of like 3 to 12 months afterwards. There's a recession declared, probably looking backwards, probably to whenever. It could be to now or late last year.
Mm-hmm.
And then there tend to be worse outcomes in the stock market, which is my main interest in it. If you, with no recession, you're a 20% decline. In a recession, you're a 40% decline on average. We're about 9% down, I think, from the peak, or from about a year ago. Who knows?
Who knows?
Let me give some shout outs to all the
please do.
Gothenburg, Toronto, what's up? Richmond, offshore platform in Israel. Is that real?
Whoa.
Edmonton, Canada, not Australia. London. What's up, London? 2 of you. Munich, Poland, Snake Valley, Nashville, Norberg, always in the house. Good to see you. Seattle, Bangalore. This is a good spread, man. Basingstoke.
That's worldwide.
Guildford, wild. I love it.
Just think about that for a second. Let's zoom out and you're on the International Space Station and you're looking back at Earth and there's all these little dots all over the world and they're all listening to us right now.
That's crazy.
How stupid is that?
We got 2 from NZ, Auckland, and investing with Tom in Wangaro. What's up? Sherwood, Oregon. Awesome.
Hey, Tom. What's on tap for today? What do we got, Toby? What'd you bring?
I got a few. Intrinsic investing.
Quantity, not quality.
Stockton. Yeah, that's what I bring. They had an interesting article saying that returns in the stock market, equity returns are for enduring the stress of holding equity. They said volatility is like the manifestation of stress, but stress is the internal thing that you feel. I just thought it was an interesting idea. I was going to talk to you guys about it, and I thought it was particularly germane given the 10-3 inversion means that there's probably some short-term volatility. But at the same time, there's also all those value indicators like the Gotham thing saying we're in the 90th percentile, which means, what are you waiting for at this point? You're waiting for
You'd have to
There's
be
not many places to go.
You'd have to be a real greedy pig to go from 90 to wait for 90 to go from 90% to 100 percentile.
Yeah, so that's gonna be my topic. What do you got, JT?
I've got a little story about this place in Pennsylvania called Centralia, that we will tie back to inflation, actually. So that should be fun.
Nice. I'm gonna listen and then I'll comment accordingly.
Yeah, just leverage.
Somebody wanted me to talk about Curate. I'm fine doing that.
All right, I could use a Curate update.
We had
I
didn't own it, so I'm fine just following along.
That platform outside Israel is not a lie. Aussie engineering expert working on a gas platform. What's up, Josh? I don't think we've ever had anybody quite as remote as that. Maybe we've had someone from Perth. I don't know.
I feel like we've had some other offshore before, but I could be wrong. I'm still waiting for Antarctica. That's when I know we'll have made it.
This is the favorite podcast of offshore drilling platforms.
It's the number one podcast in value-based offshore drilling.
Oil after hours.
3-man, edition.
That's it.
We couldn't get two
from North America.
Yeah. At the 10:30 a.m. Pacific time slot. All right, let's get into some of your stuff. I want to hear what's been on the desk of Tobias Carlisle.
I just trying to reconcile.
How's his book coming, by the way?
Oh, dude, it's brutal. It's brutal.
Okay.
We could talk that out if you need a little therapy session.
Yeah, probably. That's a good idea. I think the problem is that I used to be a blogger, and so that the discipline of writing all the time meant that I had like 100,000 words written by the time I started writing. I got to write it from whole cloth. It's rough. It's rough as guts. I mean, there's a lot of words there. They're just none of them are very good.
Is it the reworking that's the problem? Yeah, that
reworking's easy. It's just that when I go back and read it, I'm like, oh, this is trash. This is garbage. This is cringy. I got to get this up. And I got other things going on. I got things to run, little kids.
Yeah, you got
all of that.
Soccer to coach and all that good stuff.
Soccer's over. It's hip hop and tennis right now.
Okay,
nice.
Hip hop. What? What's that? Like dance?
Dance, yeah.
Dance, yeah. My little man loves it.
I bet that's like so cute. I bet he's just crushing it.
He's the only boy in like 17 girls, and I don't think he's aware, but that's his
genius.
Dude is smart,
mad, diabolical.
Yeah, it's gonna be sweet when he's older.
Yeah, I think so too. There's not a lot in the article from Intrinsic Investing, Sean Standard Stockton, those guys. It's not. I just thought it was an interesting idea. The idea is that there's always this existential risk of equity going down. So Buffett and Munger have said, if you can't endure a 50% drawdown, then you don't belong in the market.
With some equanimity, then you don't deserve.
Is that what he said?
Yeah, you don't deserve equity returns.
What if I can endure it, but I don't have the equanimity?
Yeah.
What if I have to
tie yourself to the
mast?
myself
to the mast? Yes, exactly right.
That counts too. I think as long as you didn't sell, then I think you deserve it.
Well, that's a good point. And I think we've talked about this a lot too. That the first 2/3 of the time of a drawdown, there's not a lot of action, and it's the last third in terms of time that you see all the action. So this is not to say that I think that we're still in the bear market. This is not to say that I think we're not in a new bull market. I have no idea whatsoever. I would just say that these conditions look like every other bear market ever, particularly long bear markets. They have these big rallies. I remember writing about the 2000 bull market that turned into a bear market in one of my books, and saying that it had almost rallied back to all-time highs 12 months after the peak. And it was there that you had.
And then it ran out of gas.
Crash, yeah. So that could easily happen here. Nobody knows what's going to happen. And there are lots of indicators that looks like we're going into a recession. There's been a lot of stimmy, hours worked are rolling over, all these sort of things. So there's this constant drip of bad information, but that's always the case. They say bull markets climb a wall of worry, old saw, whatever that means. I have no idea. Maybe it's exactly this, that there's always bad information hanging out there, and the good returns are always most available when the bad information is out there. That's why you get the discounts, and that's why you can buy stuff that, you're not going to get Google at the peak on a good multiple. You get it close to the bottom on a good multiple.
I think that this today's world where there's so much data, but there may only be sort of the same amount of information that there was before. But this flood of data that's available lets you support almost any narrative that you would ever want to draw. And so I think you can really, I think it's a more dangerous world today now that it's so easy to find supporting evidence to confirm any prior bias that you might have had.
Yeah, that's a good point. You've also got we
got to be careful about that.
Leading and lagging indicators. So I always quote Hope. The employment
housing
indicator.
something
Orders, profits, employment. The funny thing is, every time I say it, I don't know, I get a whole lot of emails telling me what it is. I have learnt from the emails now what it is. Thanks, guys. I appreciate it.
I think it's funnier when you play dumb myself. I think you should just keep going.
I didn't know what the O and the P. I couldn't remember the O and the P because as far as I'm concerned, when the H goes, get ready. And when the E goes,
it's too late.
When the H goes,
panic.
Get ready to go down. When the E goes, get ready to go up. That's how I've figured it. So we got an E that hasn't rolled over yet. I mean, depending on how you dig into it. So there's some Mish Shedlock has on his site aggregate hours worked, and they have an index, and then he digs down into the actual hours. And
where did they get that from? Like ADP or something?
I couldn't tell you. I didn't dig that deeply into it. I just saw it very quickly in a tweet and had a look at it because I thought it was interesting. But the hours sort of topped out in late 2020, 2021 at like 35 hours a week, and now they've rolled off the tiniest bit. And I don't know because there was only 2 or 3 years of data there. What is significant? But when you look at there's an indexed version of it which doesn't have the actual hours. It just has it relative to 100. On an index, the amount that it's come down is infinitesimal. You can hardly see it, so it's hardly budged at all. But the E you would expect the E to go last, and that's like there's a lot of reports about tech companies laying like tens of thousands of workers off.
Yeah,
but at the same time,
based on those,
they hired that many last year.
Based on those day in the life videos, you're only losing maybe 1 hour of work there per employee. It seemed like it's.
What were they thinking when they hired all of those people? Like,
that's a really good question that I think is under discussed. That if you're going to be laying people off a year later, I mean, if you go back and look at the employee counts from 2016 to 2022, huge additions in workforce. That was probably the error, right? It wasn't. It's now is just the correction of the error.
But it's not even a full correct. They're cutting back what they hired in 2022, and they're not cutting deeper than what they hired in 2022. I mean, they may end up doing that, but it's not like the layoffs that are coming out now aren't sort of reducing total employment. They're just
we're rolling all the way back to 2021 levels.
Yeah.
I don't know. I think I mean the sales per employee on something like Google is up from what is this in millions? So 1.2 million to 1.67 million.
Over what period of time?
From 2015 to the TTM. So I feel like the revenues have supported some of the employee growth. I don't know how I know like on a percentage basis, it's not like the hiring didn't really move all that much. But like, I just don't know how you incorporate that many people into a culture and even know what the hell they're doing. Like, I mean, I when I joined a team, it took probably a year before I knew what the hell was going on, and they knew, what was going on, what they could depend on me. And you got thousands and thousands of people.
Is that because you were down in the basement with your red stapler?
Yes, more or less.
Okay,
I swear I should have been.
I don't know. Like second order thinking on this too. Like how, boy, does this set you up for a lot more antitrust potential? I mean, as long as you're hiring, as long as you're, sort of being a decent steward of, society in some ways. Yeah, a good corporate citizen. And now you're laying people off for the perception of more profits for Wall Street. Is this opening the door for more potential, some regulator who wants to now use that against you and come after you for antitrust stuff? Maybe.
I don't know how much Ben Thompson has written about this, and I could kind of buy it. I don't know how much is they were depending on natural attrition, and now people just aren't leaving.
Well, it looks pretty good in there. Those stay in the life videos do make it look pretty good.
Why would you quit that kind of?
Someone just pays for your life and you make TikTok videos. That sounds pretty good.
Yeah, well, I mean, I think a less, I don't know, maybe rude way to say it is you're making well into the six figures for, I think, a lot less stress than you would have at a startup or if you're running your own thing.
Christopher Hone, he's an activist who runs Children's TCI. I think it's mostly philanthropic at this point. I don't know, but then I saw a tweet today that said that he made $1.9 million a day. I don't know if you guys saw that. He sent a note. I think it was to Google, but it could have been to Microsoft. Do you know what I'm talking
Google.
about?
Yeah,
Google, where he said, the cuts are good. You're going to have to cut a whole lot more. And it's just, and then somebody's like put above that, this guy made $1.9 million a day in 2022.
Running a charity.
Well,
I'm joking.
I don't know. I don't know if he personally made $1.9 million a day, or if the whole organization, that's what they've taken the top line and then he gives it. I just don't know how it works. I'm not sure I don't want to give him too much credit if it's not all being given to charity. And
sounds like a guy that knows how to cut and generate profit.
Wasn't well received in the Twitter sphere, but then the Twitter sphere extends outside FinTwit.
Bunch of employees that don't run anything and rely on rainmakers for their salaries criticizing a guy. Okay.
Rainmakers still need the people who do the grunt work. You still need the operations.
No doubt it is symbiotic, but I respect those that have made the rain, especially those that have run their own organizations quite a bit more than I respect those that collect the rain. That's a tough
letter to send. Like, that's not a good look to be sending a letter like that. It's not like I don't think Buffett would be dumb enough to send a letter like that.
Oh, he would. Well, maybe not a letter, but he would totally do stuff like that. You're talking about a guy that drew a line in a warehouse and said, get the inventory under here. This guy used to buy companies and suck them dry. And
I think he learned his lesson, though.
Yeah, after he made millions and millions and millions of dollars. Like, this guy is not some saint his whole life. I love the Bob dog, true. But let's not rewrite history.
Do you think that there's do you think that he's been talking to Tim Cook, which I think Apple kind of conspicuously now hasn't been doing layoffs? Is that true?
Well, Tim Cook took a 40%. Right.
So Tim Cook takes a pay cut. They're not doing layoffs. I wouldn't be surprised to see them zig when everyone else is zagging, and maybe they lean into this and they hire people. And with the idea that I could see Buffett going to Tim Cook and saying, hey, I don't mind if we look a little less profitable for a few years. That's fine. And if, by the way, if the stock happens to tank because of that, back that buyback machine up, baby. And let's just load up on this and concentrate my ownership. And 5 years from now, it'll be all good.
Does that also help you avoid like antitrust action or any kind of like adverse regulatory actions?
This is your invincibility, Toby.
I don't think Buffett necessarily does it out of the goodness of his heart. I think that he's just sensible to the public perception of very successful, wealthy men calling for layoffs in these kind of companies.
I mean, look, this is the other side of all this, okay, is pensions do need returns to generate what they need to pay the people that will benefit from the pension. And those pensions do own these big companies.
Mm-hmm.
That's true.
And these companies also give stock to employees, which happen to be a key resource. And you don't want your stock to go down so far that your employees are disgruntled. Like, there are more reasons to do this than just some hedge fund guy writing a letter.
Well, and the inversion.
I know that this gets lost in,
the inversion of this, of not laying off, looks like Japan over the last 30 years. And you end up with ossified structures, you end up with low returns on equity, you end up with markets that are sideways for a really long time, and stasis and just clogged toilet bowl of capitalism.
Do you think that's overvaluation as much as it is just the failure to sort of renew underneath? Yeah, I guess Japan's been very, very cheap. I guess that it was overvaluation initially that drove the decline, but now it needs a reason to get up, right?
Well, if you're earning anemic returns on equity,
Yeah.
you should trade at a low price to book. Like that is logical.
Yeah, that's right.
Facts, true facts.
I think that Buffett and Munger, and I'm basing this on, they got a fair amount of heat in, I don't know, call it the 2012, 13, 14 time range with their relationship with 3G and 3G right-sizing companies, right-sizing.
Yeah.
And
Munger used to wax poetic on 3G.
Yeah.
They're doing God's work.
This is what I think they would still probably say, that there's businesses should be right-sized. We're not all farmers like we would have been, 100 years ago. We have to keep making forward progress on what jobs are required in an economy. And they would say that's, it's unfortunate for the people who are on the wrong side of that, and there should be safety nets for those people. I think that's the part that's sometimes missed in the conversation of what they bring up. But I don't think that they think that capitalism should be this hammock.
The TikTokers aren't really doing themselves any favors with those.
That's a bad look.
But it's hard to see how much work they're doing, and they just seem to eat for free and hang out. No, like, looks like a pretty fun pad. It's like
those are just the bad
daycare
apples,
for adults.
So you get those in everywhere.
Then again, they could be marketing. Like, that's what marketing does, I suppose. Lets everybody know.
Yeah, they're just stupid influencers.
They tend to be young, also. I don't know if you noticed that.
Do you think? But is that like that when you first come in, you're essentially, it takes a long time to skill up. You're essentially useless. They kind of like, there's that old joke about the person who goes to hell, and it's great. It looks like one of those day in the life TikTok videos, and then they're revived and they come back to life, and they're like, oh, hell's not that bad. And then they get sent down and they're like put in chains and thrashed, and it's really hot. And they're like, what happened to the other hell that I was in? Like that was the internship program. Now you're here full time.
Now you're here.
That's right.
Yeah. I don't see any 50-year-old overweight middle managers who are just grinding daily in the day in the life videos.
50's
yeah, that's because they got kids they got to put
it's
food
usually
on the table for.
Young, cute girls.
Yeah,
whatever.
Yeah, it's good marketing. I guess as a program to induce people to come and work at those companies, like that's doing a pretty good job. It makes me want to work there. I want to go and work as a first-year marketing associate at Google.
First year.
I don't know anything about marketing. I could probably learn TikTok.
Doesn't matter. We'll get you onboarded.
Figure it out. We got a little bit sidetracked, but the point that I was trying to make was that there is always a reason to be scared in the market. And on the other hand, we've got, AQR, like we talked about last week, Gotham, the Alpha Architect website, all of those guys have got.
They're all kind of pointing the same direction, right?
Like we're in the 90th, 95th, whatever percentile of cheapness. And you can say, well, clearly it can go to 100th percentile, like that's happened in the past. It can go beyond the 100th percentile.
You can make a new 100th percentile.
Yeah. And when you look at the Gotham side in particular, when you go beyond that 90th percentile, you look at all of those dates, it's like 2000, 2009, like they're dates that you're like, I really I want that date because the forward returns are like 100% plus. But to get there, it's painful.
Weird about that though, is that those dates also corresponded with other valuation of the market metrics that made it look historically much cheaper than today, which is kind of a weird thing to square.
Don't you think it's like a 2000 type scenario where the market itself can be quite, I don't know, maybe the market's not expensive because the FANG is a big chunk of it now, and maybe FANG's more reasonably valued given where it is, but you can have the split where
the bifurcated market
value is undervalued.
Structure.
The market is overvalued. The market does nothing. Like the market there are lots of people out there saying the market's going to do nothing for a long time. I think the last time I looked at the estimate, which assumes mean reversion over a decade, I think it was like, it's at 3 or 4% annually at the moment. Do you
That's all dividends.
Well, dividends are less than 2% now. There is some top level,
They
but
might
then
come back. Who knows? We'll see.
That's before inflation. That could be negative on an inflation on a real basis.
Yeah, how many portfolios today are structured, or how many in financial plans for retirement or pensions or whatever that assume some rate of return in them have that as a permutation within the plan that you could be 10 years from now and have no price appreciation?
Well, judging from Twitter, there's a lot of Tesla, like single stock owning people out there. Tesla.
Man, I saw like retail has really poured a ton of money into Tesla in the last like 3 months or something.
Some of the websites that I go to quote Tesla up beside SPY, like it's S&P 500, NASDAQ, Dow, Tesla, because it's one of the most heavily traded. For many people, it's traded like it's the market. It's the only thing they look at. There's a guy he had this really pretty house in Los Angeles. He sold it to go and stick it all in Tesla.
Probably equally as overvalued.
The house.
Yeah.
Well, that's fair. that might not be a bad trade.
Yeah.
On a relative value basis, that's a good point.
They're both taking some pretty big duration risk there.
There's some great housing crash porn on YouTube. You can go down a rabbit hole there. I've gone right down that rabbit hole. There's some, according to the housing crash porn, and so I try to call it that so I know it's ridiculous and I'm trying not to get too sucked into it. But
like, what do they say? Is it rates? Is it demographics?
Yeah, mostly it's
all.
The current argument, the one who I follow, this guy's current argument is that unlike in 2007 and 2008, where it was the low doc ninja speculation, this time, well, I guess it's the same thing. It's just, he says the lending standards are a lot tougher now than they were then. There's unlikely to be any of that kind of stuff. However, there is an enormous amount of speculation. There are lots of these robo buyers like Open Door and all those kind of guys. Plus, there are lots of individuals who have pyramided up debt and speculated in there. And he's got some way of estimating. He says that for a period of time, from like late 2020 until sort of late 2021, call it, he thinks that the speculation, the house flippers were like 100% of some of these markets. There was very little residential,
like real owner, like real person who's going to live there.
Yeah. And they push the prices up, and they like seeing the prices going up. So it's not such they're less sensitive to prices because they're not planning to live on it. They're planning to flip it as quickly as they possibly can.
Different duration.
And so now, like all of it, and then they can track that as they turn and resell these houses. Like they're now starting to take quite serious losses in these things, which means that behavior sort of goes away slowly. And then he tracks various other metrics that precede busts by periods of like 9 months to 12 months. And he says they've all rolled over in the way that they did in 2008. It's just that it's too early for anything else to sort of appear. But the guy's like, it's coming, and it's just about here.
I mean, just anecdotally though, does it feel like I remember 2006, 7, 8 housing market, especially in California, and that, exotic dancers owning 6 or 7 houses. It doesn't feel like it's been that, does it? Or am I just not running in these circles, which I'm not as a 40-something-year-old, suburban dad?
Yeah, I don't know. Anecdotally, I don't know. I don't know anybody
Bill,
doing
what are they saying in the strip clubs these days?
I don't know. No, I mean, I think the lending standards have been cleaned up quite a bit. So, I don't know who ends up holding the bag, and I don't think it creates some systemic risk. I mean, if you get some off, non-bank financial lenders that, go to zero or whatever, I'm not sure that's a huge deal.
Yeah, Nick Fisher says they own Airbnb. There's a lot of Airbnb, STR, short-term rentals.
Yeah, but that's like a legitimate way. I don't know why that would change going forward. I mean, I think that's like a legitimate way for people to get yield.
Well, if you're using that, but if you get that assumes you're getting yield out of it. If nobody's renting your place and you leave it on it and you're missing payments because
Yeah,
that
but I
game's
mean,
over pretty quickly.
we're going to talk about a scenario where people all of a sudden start valuing travel less. I mean, I think you're fighting a 20-year structural preference shown
Agreed.
among people,
But
which is fine.
I think you also had an acceleration of that though when like work from home was fully in like full bloom. And if there's more back to office, you're not going to, hang out in the Appalachian Mountains or whatever. And when the firm wants you back in the city.
Yeah. I mean, look, I'm sure some people will lose. I mean, it's a cycle and
aggressively to get into that, then I could see that having some cash flow issues.
But I don't know how many lenders are aggressively financing out there. Banks aren't. So it's got to be something non-bank related.
Yeah. I don't know.
I mean, I'm sure it will cycle down. I mean, but I'm happily long what I'm long.
I've got a good comment here.
Not losing any sleep over it.
As a connoisseur, it's a JFD VV4. As a connoisseur of housing porn, interest rates are pricing out a bunch of people from owning. I don't expect a crash, but conceivably 30% nominal price drop. Yeah. So that's my definition of a crash. My definition of a crash kicks in around 20%. I think below 20%, 30%, that's a crash.
We'll see.
Yeah, I don't know. Nobody knows this stuff. I just like watching the tea leaves, and maybe
you'd probably still be above 2020.
Yeah, possibly. I mean, possibly.
I mean, I don't know how to time things. Like I'm not great at timing tops and picking bottoms. So, I don't know. It could go up, it could go down. I think over time, you own good housing assets. You're probably not going to lose nominally. Of course, you're going to have to pay. And I think housing generally that you live in is a shit investment, but it's not an investment. It's it's a luxury purchase. Yeah, but you got taxes and you got all the repairs that nobody ever talks about when they say I bought this house for this and sold it for
all
this.
my profits.
You got raped just like the rest of us. Yeah.
I bought it in 1989. That's the secret. Buy it 30 something years ago.
Yeah. Step one, and I'm build a time machine. Step two.
Well, and I'm excluding my $20,000 roof that I had to replace or my AC, or the taxes that I had to pay. But, makes my wife happy and it's better than renting, I guess.
Sometimes.
Not always.
I don't know.
Yeah, not always.
Yes.
Yeah.
Should we bang out some
yes to all
vegetables?
Let's do some veggies.
All right. So there's this little town in Pennsylvania, rural Pennsylvania called Centralia. And apparently there has been a mine fire in a coal seam that is underneath the town that's been burning in this labyrinth of abandoned coal mines that are underneath this borough in Pennsylvania. And it's been burning since at least May of 1962. So it's 60 years.
It's like May of 1962.
Well, so
What day? What time of day?
May 27th, possibly.
No kidding.
Yeah, people don't actually know what the original cause is. It's likely that it started from a planned burn of this dump site. Like they just had like a dump out in the middle of nowhere and like decided to burn whatever the hell was in the dump. And like it probably fell down into this coal seam and then spread through these caverns underneath the town, basically. But it is there. The estimates are at the current rate that it's burning, that it could continue to burn for another 250 years. And so what's happened is that all of basically like there are holes around this town that are just belching out carbon monoxide and it's hot, like the ground is hot, like a gas, like how like a filling station will have an underground tank, to store gasoline in it. It was like 170 degrees on that tank when they'd measure things. So basically the town has been abandoned at this point, like and most of the buildings have been razed, and it's just like, okay, we had to shut this whole thing down. And
is it cheap? Like how much for a house?
Yeah, we're gonna buy our own house.
We'll flip something.
Yeah, let's flip it. Apparently the video game series Silent Hill is drawn on the events of this Centralia mine fire, which is kind of an interesting little tidbit. So, all right, fun enough story, but I actually learned about this from reading a recent interview with Jim Grant. And what he said was that inflation is such a system, it resembles one of these inextinguishable, long-burning underground coal mine fires. In Pennsylvania, there's been such a fire that's been going on for around 50 years. You don't always see it, but it flares to the surface from time to time. It's always there, and it's always latent, leaking smoke, warming the soles of your shoes. To me, this is a good analogy for inflation in a free spending and paper currency issuing social democracy. So I thought that was like pretty powerful to think through of, like how much fuel do we have in our current like underground latent inflation potential? Like how long would the fire be burning? And the reason I bring this up is that I stumbled across this chart that talked about, CPI in the 1970s. And if you go year by year looking at it, we all think like, oh, you sort of take this big blob of, oh, there was inflation in the 1970s, but try to separate yourself from that and like live within each one of those years. What would you have been thinking from year to year? And, where's the federal funds rate? What's the market doing? It's all this stuff that we're trying to figure out right now. Let's look back at a year by year slicing of this to sort of have that lived experience and see if we can learn anything from it. And what ended up happening was like CPI in 73 was 6.2%. And then 74, it's 11.1%. It's like, oh man, this is like accelerating away from us. It's getting out of hand. 75, 9.1, and then 5.7. And so now you're like, oh, okay, maybe we've gotten to the other side of this. Like maybe we're like kind of solved it, right? And we had a big market crash. The Fed funds rates pushed up. Like maybe we've like enough, there's been enough recession here in 73, 74 to calm this coal mine fire, right? But then it flares back up and now we're at 6.5, we're at 10, 14, 6.5, 7.6, 11.3, 13.5, like it's accelerating away from us. And, just imagine every year it's getting worse like that and you're living through it. And the Fed funds rate is going, it was 5.9 in 1976, then it's 6.5, then it's 10, then it's 14, then it's 18. Like these are huge moves compared to anything that we've looked at for 2021, 22. I mean, just night and day differences. What I'm just trying to get at is that we probably can never really know how much coal there is that could be burning from all this. But the lived experience of it could retreat over the next couple of years, like 22, 23, 24. Maybe it retreats and maybe then it comes back with a vengeance. I don't know, but just to kind of mentally prepare yourself for that is a possibility. It's happened before. I think the good news is if you want your confirmation bias, value stocks over that time period. And I don't know how it was defined in this particular chart that I'm looking at, but they ended up doing pretty well over that time period. And the S&P did not do very well, especially on an inflation adjusted basis. I mean, you were down 75% from peak to trough in the true 1970 real return basis on the market, which is kind of missed. I think it came in at 48 nominal, but it was like 75 loss of real purchasing power.
Which is worse than 29 on a real basis.
Well, does it end up being, I don't think it is worse than, is it? I don't know.
That's my understanding that the 70s crash was worse on a real basis than 29.
Is that because you had actual deflation within the CPI for the 30s crash? So you sort of like gained a little bit back, even though nominally it was a bigger crash?
Yeah, I'm not sure how. I just remember that being a true fact that I learned a long, long time ago. Okay.
Well, let's not finish that one then. So right now, here's another, the Fed had to raise rates, like we said, to 18% in 1980. And that, was probably this big giant, like dumping of a cold water bucket to extinguish this underwater or underground coal fire that was burning. But to do that, I mean, you had to get the 10-year dramatically above CPI to tame inflation. And we, today, right now, CPI is at 7.1 and the 10 years at like 3.5. We're pretty far below. Are you ready for the world where if the CPI is at 7 and we have to get the 10-year to 10 to calm this inflation? Like, what does it even look like? Can we even do it? I don't know the answer to that, but it's
Not in the short term.
it's pretty hard to
Yeah,
imagine.
can you
right?
even do it with government debt?
That's the problem, is all these debt levels are so much higher than they were in the 70s when they
The
were
Fed is
executing
independent.
this.
The Fed is independent. It doesn't look at, it's not
Oh.
concerned by those sort of things. That's the federal government's problem.
Yeah, good
Like
point.
the BAJ is completely independent. Not
Well,
concerned at all by.
And to give you guys a little sense of like, where is this on the radar for a lot of people? Like, I don't think that people are thinking about this right now, that inflation could come back. And as evidence of that, yesterday, Wall Street Journal had a little detailed note about Treasury notes that are maturing in 1 year are at roughly a 4.7% yield. But inflation protected securities like TIPS for that same month yield about 2.7%. So that's suggesting that the market is anticipating a 2% headline CPI basically in January of next year. So there's like, the market is saying that this is going to like fix itself, and it's possible that it might. Like, the market might have come up with the right answer, but what I'm saying is just be careful that you could very well be offsides on that if you believe it too much. And just to like recognize that if that ends up not being true, that it could be very painful to move rates up high enough to get this underground burning coal mine under control.
What's the source of the coal in the inflation example?
I mean, I tried to think about like, is that like the Fed's balance sheet? Is that the equivalent of how much coal there is? I'm not sure if that actually holds up very well, so I didn't say that.
Let me ask you this. If raising interest rates kills inflation, what does lowering interest rates do?
That's a trap.
And then if you lowered them for a really long time, like what would you expect to see?
Yeah. And how
I don't know that I
QE up
agree
into
that raising interest
2022.
rates stops inflation, or I don't know that I agree with the premise.
Well, isn't that what Volcker did? Raised interest rates.
I don't know that I believe that the Fed is what killed. I don't know that Volcker killed inflation. I think that that's what people tell themselves. I don't know. Ask Jem Carson or Bill Wabufo, but both of them disagree with this, and they're both way smarter than me on this.
But what do they say?
I can't recall it off the top of my head because I'm an idiot. But
I haven't seen Wabufo in the comments today, so I don't know if he's listening.
But I don't know. I mean, I think there's a theory of the case that you could say that decreasing interest rates incentivized like people to look so far out with their investment horizons, VCs in particular, that there was so much consumer surplus that no one needed current return, that it actually had a deflationary effect on, you know, some of the things that we use. I think it would be impossible to argue that the rich didn't get richer and that didn't result in some sort of inflation on the goods that they spend money on, which ultimately like ends stocks. Up in popular lexicon. Well, and restaurants and travel and stuff like that.
Christian Colin says that M2 money supply grew 37% since February 2020. That's a lot.
Yeah, well, I mean, we had a global pandemic, and then we flooded the system.
Yeah,
right? I mean,
how does flooding the system with money solve the pandemic? just
well, I think that when the stock market was crashing and we thought that you were supposed to keep everybody inside, stabilizing the market was a smart decision from a policy standpoint. I mean, you do have elected officials that are there not for the purpose of like just markets. It's also like to keep people safe. And at the time, they thought people going out was going to be a risk. And I think that if you have the market completely collapse, the probability that people watch their 401ks go to zero while they stay inside is very, very low. And I think when you can't spot a treasury, it makes sense to come in and stabilize the market. Now, I don't know how the fuck they did the numbers. I wasn't in the rooms. They were throwing darts, but like, I don't think any of us would have done any better. And I don't think not doing anything was the answer at all.
I don't like these counterfactuals because you just, I mean, I don't know if propping up the stock market is the right thing to do.
Well, I thought it at the time, so I think it now.
Well, my issue is that we have to, there's always the question in every economics, and then what? And that has to be answered. And I think oftentimes we don't. And my other issue is that we need to give the patient methadone to help them, right? But the problem was is that you were giving them heroin for so long before that you got them strung out on it.
Yes. Well,
Yeah.
this is my beef with the entire Trump budget, right? Republicans, all they do is bitch and bitch and bitch. And I am a registered one, so don't turn it into something that it's not. But like then Trump gets in and we're 6 years, 8 or 7 years into a recovery and we blow the budget deficit out. Like, okay. So then what?
Yeah.
Now that Biden's in, we don't like how he spends. So we're going to say you got to rein it in. Like it's just a problem. But I don't think 2020 was the problem. I think it was
How much influence
all
do
the
presidents
other
actually
stuff.
have on the spending? Because it seems to me it just doesn't matter who comes in, it goes up.
Yeah,
it's
well, I think
unfunded,
that's part
and
of the
there's a
problem.
The deficit is funded through.
I mean,
debt.
that said, I don't believe that you're ever going to pay it down to zero. That's kind of stupid. We
The
run a
problem is
levered equity strategy here in America.
The problem is it removes your flexibility. Like the last time we had debt levels like this was after World War II, right? And it was because we'd fought a world war. This time, we just got a lot there. Hope we don't have to fight a world war.
Yeah, I mean, look, we may have to default. Like, I don't know why that's shocking to say out loud. Like, it might have to happen.
I mean, it did wonders for Russia. They've got low government debt to.
Yeah, well, I mean, look, it's maybe not roses in the future, but I don't know what to say.
Fortunately, I have a deep value strategy, so I'm going to be in the crash position and bounce free of the wreckage.
Right.
Just roll safely to the side.
I've put my head on the back of the seat with my arms over the top of my head, which I understand is how you survive the crash. All those other people, I don't know what they were doing. I jest.
Yeah, I don't know. It's going to be interesting to watch. I'd rather be here than anywhere else.
That's a good point.
Your mic has gone a bit funny, JT. Did you yank your mic out?
It's died for a second on me. I'm resetting it. Because our crack audio video team here.
I can't be blamed for that one.
Yeah. Is that better now?
Yes.
If we go into a 70s style high inflationary environment, that has typically been good for value. Not that this is a value podcast after all. Do you feel like the scenario is good for value now? I mean, it seems to be. We're in those 90th percentile, but all of those numbers seem to, well, Greenblatt's numbers only run back 20 years or so.
Yeah, that's a difficult part as okay, he's going back to like the early 90s and has a data set, right? And when his basket looks this cheap, his Gotham earnings yield is at this level, the 2-year forward returns have been very attractive. The thing I wonder about that is that has been there's been a one-way interest rate bet roughly for that whole time period. It's been, call it high to mid, at least for treasuries, the 10-year in that time, starting out and going to zero and negative in a lot of cases, right? So if you're doing a sampling, what you have to assume that like it covers enough of the data set that where all of those sort of like one-way things have had multiple cycles to get incorporated and counted, right? That it's currently sort of an exogenous variable, like it's another independent variable at that point, that if it's only a one-way thing. And so I don't know if you can draw much inference on what the 2-year projected returns look like if you enter a new environment, which would be an increasing rates environment.
We definitely have equity returns for increasing rate environments, though. We've definitely got equity returns for the 70s.
Well, that's what I'm saying is like, Greenblatt's data set doesn't go back that far. So I can't hang my hat on his number of saying 60% return from 2 years from now, which is what his data set says. I don't know. I feel like you could probably say pretty well, like you're going to outperform probably based if you're starting on the 90th percentile, but the absolute return level, I don't know if that's even like an apples to apples comparison when you have different rate environments.
Yeah, I've definitely seen data that the the acquirer's multiple, which we tested through various different environments. I had a look at it specifically in relation to 70s type environments, and it did work. But then that doesn't talk about, I don't think I would have looked at the starting valuations. That was just seeing whether it worked over that period of time. Just basing it from, I'm sure we did it by decade in the book. 1 second. Let me have a quick look. Talk amongst yourselves.
Yeah.
Roger Dodger. I get tagged in a lot of these curate threads. The only thing that I would say is you could buy the debt and get 13%, and you can buy the preferred and get a 20% current yield and have 2.5 times upside. So I just don't understand you guys that are still jerking off over the equity.
But if it works, what's it going to do in the equity?
Well, I mean, that's the thing. I mean, I guess you can argue that you could get a whole lot more, but I think you got to define what work is. Obviously, if it becomes a growth asset again, then yeah, it could rip. But on a risk adjusted basis, I don't know.
Do you believe that the cap structure is such that it's a binary bet for each one of those securities?
I think the market thinks so, because that's why I think that's how you get a preferred that yields 20% current with 2.5 upside.
Yeah, it's
right?
kind of telling you that they're calling bullshit on that.
Yeah. So
what's the curate scenario? When does your curate bet run out?
Oh, in March. I don't know what they're two just pathetic picks.
That's pretty funny. They've both been demolished.
Both just
destroyed.
Oh,
it's
man.
a shame. Oh well. Tough
Are
game.
you ahead? Do you know?
Yeah, where are you at? What's the
I don't know. I mean, recently junk has bounced. I don't know. I don't know where Zoom is. I haven't looked in a while. It's best to just hide from these things.
You got some cash back there, didn't you?
Yeah.
Cash and securities. Even the basket of cash and securities is underperforming.
It's been a disaster. Like objectively. Be nice to say it's not, but it has been.
What's the main problem? Is it the financial engineering knackered them, or just the underlying businesses? So,
they had a lot of stuff. It was they had a major fire at their main fulfillment center. They had a CEO change. It's a mess. But we'll see. David,
was there any
David
COVID bump in their data? Like there were a whole lot of people when they were home, they were doing a whole lot of home shopping for that.
Oh yeah, that was the whole theory, is that if you look historically at the cohorts, it's very predictable behavior. Those cohorts are not performing like I would have expected them. So
the power grandmas.
Therefore, I was wrong. Yeah, well, it was odd in the beginning. They said that they didn't see any difference in the behavior. So I thought the addiction would stick. But if you go around the grandma Facebook groups, I think that some of these fulfillment issues have really upset people. According to David, they kind of messed up. David's the new CEO. They kind of messed up the merchandising. So he's trying to fix that a little bit.
The wrong cat sweater.
No, they got into a habit of, they have this, the whole purpose is a daily special value or today's special value.
Yeah.
And they got a little bit lazy on defining the word today. So they might offer today's special value 3 times in a month. And then, you stop, that psychological aspect. Yeah. And the psychological aspect of like, I need it now, otherwise I'll never see it again. You start to see the same items, then you get less urgency.
Yeah.
And then you're not getting them delivered as timely as you were. And then there's a fire. It's
dopamine loss there.
Yeah. And it affects the shoulder programming. So it's it was a psychology bet. And from what I see, the psychology is not stuck. And that was the one thing I was not willing to compromise on.
Zoom got smoked because it was just one of a bunch of those.
Bubble basket.
Beta bet, more or less.
What's the emblematic stock out of that entire run up and run down? Beyond Meat. We got Carvana.
Zoom was pretty. I mean, Zoom was pretty poster child of COVID.
Now, is this Zoom or the ZM or a ticker?
I mean, all of those stories.
People bought both.
Yeah.
It's a bummer that Michael Lewis is going to do he's going to be on crypto, because I feel like somebody needs to go through all of those those bubble stocks that blew up.
I mean, I would like to read a bad blood equivalent for Carvana potentially. That might be interesting.
Peloton, yeah, that's a good suggestion. That's in there.
I mean,
as well.
Fastly was one. They were all going to get taken out. Everybody was it'll get taken out way
Apple will buy
higher.
it.
Yeah.
Did you say Apple?
That's what Apple
Oh,
needs
Apple
is a
will buy it, yeah.
CDN.
GameStop, yeah, gee, there are lots of good stories in there, isn't there?
The history
BlackBerry.
books will be rich for this time period.
I want to read one because I don't think I've lived through one before. I sort of caught the tail end of 2007, 8, 9, but I didn't see all the speculative excess beforehand. Yeah, car vending machines. That's not a bad idea. Maybe it works. I don't know. Maybe it doesn't work. I don't understand why you can't customize your car. And the setup for car dealerships makes Tesla's approach so much smarter. Like the thing you look for a car that you want, and then you go to the lot, and it's just not there in the configuration that you want, and they try and sell it to you, and it's got the sports package. It's $459. It's already bolted in. We can't take it out. You can take it or leave it. Like, I don't want it. I don't need it. I get bigger mud guards and like some mats to put my feet on for $450. Why can't they just have one car you come in and drive on the lot, and then you go home and configure it and they deliver that? How hard can that be?
Said like a true
That's
Australian. How are you supposed to, get upsold and then sold into financing and then sold into your
Do it on
paint
a
protection
website.
film?
You're gonna need that undercover spray.
Full self-drive.
Yeah.
Self-driving.
What's the spray that they put on?
Yeah, you're undercoating the carriage.
The undercoating. And they've got some there's always some security system that they can just turn off.
Oh yeah.
But you got to pay for the security system too.
Well, you got to keep your muffler bearings lubed and your
because you spend like the first 4 hours just negotiating with the dude on the floor, and that's not, you think that you've defeated the final boss when you come to an answer, and then they walk you into a room with the closer, with the finance guy, and he's been there forever, and he just knows how to extract that last $1,200 out of you.
And that's all their profit.
That's what he does every day. Yeah, that's right. He makes their margin. One dude in a room. Yep. He's selling you the undercoat and the security system and the financing, and yeah.
I got to give credit to the Teladoc call. That stock is down from it looks like 290 to 28. That's a pretty good poof.
Virgin Galactic, Robinhood, DocuSign.
Oh, yeah, Robinhood.
There's quite a few on there. The COVID stocks.
Yeah, there were a lot of them.
There was a little bit of euphoria. I think we could safely throw that flag now, right?
How's Beyond Meat doing as a not as a stock, as a business? Are they still growing?
Hopefully not.
Hopefully.
No, they're not. But they're. I mean,
What about Oatly?
Look, if you were a 2019 company and you had 300 million in revenue, and I told you in 2022 you'd have 440 million in revenue, that's not terrible 50%. Top line.
Yeah.
Is that Beyond?
Yeah. Oatly. Let's see what Oatly's doing. My wife loves oat creamer. Drives me.
Yeah,
nuts.
that is a lot of people I've noticed that a lot of people order that.
Yeah, I mean here.
I don't think that's going away.
I mean, assuming the data that I'm looking at is correct, revenue in 2019 was 204 million. This year it's 713 million.
Whoa,
that's good.
Yeah,
growth.
yeah.
This is
Oatly
the tough
seems
thing
to be
about buying
stickier
those.
than Beyond.
Is it because there's sugar in it?
God, this gross profit sucks though. What a shit business.
You just have to get to scale, Bill. It's just always
I'm
just
sure.
right around the corner.
I mean, if this thing could eke out 20% gross margins, I bet they'd be happy. God, what a miserable way to live. It's fine if you can issue a bunch of stock and get paid, but get out of that thing. I wouldn't want to own it.
SBC. Fellas, we made it.
We did it.
I tell you what, forget about SBC. I'd be taking stuff in cash and restricted shares.
Yeah. Yeah.
I wouldn't want any options or anything like that.
You'd be JG Wentworthing your just give me the cash now. I don't care.
That's exactly right.
I saw there's some guy, he's he's got some. It's called Deal, DEEL. It's like some sort of HR hiring thing, but they've done a round at $12 billion with $300 million in revenue, and that's so that they can do a $30 million cap raise and a $20 million sell down. I was like, yeah,
Good for them.
You guys know how it works. Good to see
Yeah,
that the golden
gotta-
goose isn't dead yet.
Just you know, you tip your cap to stuff like that.
Dude, that's a new Singleton type of stuff. You're just issuing hand over fist when they're giving
when they'll take it.
When they'll take
12
it.
billion on $300 million in revs.
If the ducks are quacking, you got
How
to
much
feed
do
your
you
ducks.
That was good. Thanks, fellas. We'll see you